So as far as this question is concerned, it's quite a complicated group structure in the sense that we've got these two companies, Phoenix and Owl. So the first thing that I'm going to do is our group structure. So we've got Phoenix and Owl, and Phoenix originally it bought 10%. Well, that's just going to be a trade investment, no impact upon goodwill. We then bought 65%, so we achieved control at that particular date. And then we bought a further 15%, which took our investment up to 90%. So we've got all of the issues that could potentially arise here. So as far as our friends the NCI are concerned, when we owned 10%, we didn't have an NCI, but they did have 25% for a period of time, and they also had 10% of the shares for a period of time. So in terms of doing my net assets calculation, we're going to have one at the SFP date, we're going to have one at the control date, which is when we had 75%, and then another column for acquisition 3, when we made our third purchase, when we took our investment up to 90%. What I'm trying to do, I'm trying to get a picture in my head of the relationship within the group, and that's why I always have a group structure diagram, because it helps me to build that picture in my head as to the nature of the adjustments. Having established that, I'm now going to work my way through the question line by line. So the first thing that I have is PPE, and I've seen that this is going to be adjusted for some fair value items, but we start off with a figure of 180,000. Next it comes to inventories, and again I've referenced inventories to something else, so I know that there's going to be an adjustment required. For receivables, receivables have not been referenced to anything. So what I can do here is go straight to my statement of financial position and just slot in the number. Similarly with cash, there doesn't appear to be any adjustment, so therefore we can work out our total figure. Remember, you get marks in the exam for individual items that you get right. That might only be half a mark for each of these, but lots of half marks can make a big difference, can't they? Share capital, the share capital of the parent company, is taken directly to the statement of financial position. The share capital of the subsidiary goes to our net assets working. So I've got share capital here, 50 million at each of the dates. In terms of reserves, we've got the reserves of Owl at the SFP date, so I'm going to put that into working number 2. And we also have the reserves of Phoenix, our parent company, and those reserves are 195. Loans, no adjustment required, so therefore as far as loans is concerned, 87,500, and when it comes to payables, that works out as 82.5 million. So I've taken all of this data and transferred it to a mark earning position. Let's now go through the additional information. So on the 1st of January, we bought 10% of Owl's shares for 12 million when AL had reserves of 4.2 million. Now, the value of AL's reserves at that date is of no relevance from a group point of view because we had neither control nor significant influence. So I'm going to ignore the 4.2 million, but I am going to put in the cost of the shares. So the cost on the 1st of the 1st X2 is 12 million. On the 1st of January X4, we bought 65% of AL for 120 million. So here I'm going to say the cost is on the 1st of the 1st X4, I've got a cost of 120 million. And at this date, AL had reserves of 40 million. Well, this is the date where we have achieved control. So therefore, I'm going to go to my net assets working and to say at the control date, reserves of 40 million. The shares bought in 20X2 were worth 25 million at this date. Remember, when we go from having a trade investment to having control, we revalue the shares. So I'm going to calculate my revaluation, and that's going to be 25 million less the original cost of 12 million. So my revaluation is 13 million. So I'm effectively debiting the cost of the investment. I've got to credit something, otherwise my accounts aren't going to balance, and we credit group reserves. This would be shown as a gain in the group income statement. So revaluation of the subsidiary shares is 13 million, and that has come from working number 3. There were no fair values to AL's assets except for buildings with a carrying amount of 11 million, which Phoenix valued at 16. So my revaluation or my fair value surplus is going to be, at this date, 5 million. So the way to think about it is always, every time you put through an adjustment, think debits and credits. I'm debiting PPE, I'm increasing the value of PPE, but at the same time, what would we normally credit when you revalue? You normally credit reserves, don't you? We normally credit a revaluation surplus. So I'm now going to go down to my net assets working, and here I'm going to say fair value adjustment. And that fair value adjustment is 5 million. And we still have the asset at the SFP date. So that's going to be for all 3 dates. The buildings had a remaining life of 10 years at this date. So we need to charge depreciation. Now the depreciation really gets us thinking carefully. When did we acquire control of AL? This was on the 1st of January X4. We are now at the 31st of December X7. Use your fingers. X4, X5, X6, X7. It's 4 years worth of depreciation. So that's going to be 4/10 of 5 million. So that's our depreciation adjustment. 4/10 of 5 million means at the SFP date, I'm going to reduce the value of the PPE by 2 million. Now we're at the SFP date, so here I'm going to take off 2 million for depreciation. However, we also bought some shares in AL on the 1st of January X5. So we've got to consider this other adjustment, or this other acquisition date. So what I'll also say is that between the 1st of January X4 and the 1st of January X5, we'd have also been charging depreciation. You charge depreciation every year. So I've got to charge 1 year's depreciation on the assets. because I took control of the company in X4, which is here. But a year later I bought some more shares, so therefore I would have charged a year's worth of depreciation, so that's going to be 1/10 of 5 million, like so. So that's quite sneaky. Okay, not many people I think would have picked up on that. The next note, the shares of Acqn were trading at $3.40 each on the 1st of January X4, and we used the fair value method to measure goodwill. So what I'm going to do here is I'm going to say the NCI at the 1st of the 1st X4, which is the date which we achieved control. How are we going to work out the NCI? Well, let's take a look. Acqn has 50 million shares. At that date, the NCI has 25% of those shares, and each share was worth $3.40 each. That gives me an NCI at acquisition of 42.5 million. I'm going to take that NCI and move that up. So NCI at the control date, 42,500,000, like so. The next note says on the 1st of January X5 we bought 15% of Acqn for 36 million when Acqn had reserves of 51.5. So I'm now going to go up and say at this particular date I've got reserves of 51.5 million, so I'm going to slot in that number. The cost was 36 million. This is going to be our adjustment to the NCI calculation. So I'm going to have working number 6, it's going to be my adjustment working, and I'm going to credit cash $36 million, like so. Finally, it says during the year, Acqn sold goods to Phoenix for 24 million. I'm running out of space here. I'm just going to slip this into a working number 7, inventories. And remember our rule, cost plus profit equals sales price. And our profit is 50%. 50% of what? Well, it's cost plus. So I'm going to add that onto my cost figure. So my sales price is 150%. At the 31st of December, this should say Phoenix has 9 million. So apologies for that. That should say that Phoenix has 9 million of these in inventories because Acqn sold the goods to Phoenix. So the sales price of those was 9 million. The profit is therefore going to be 50 150ths times 9 million. So that works out as 3 million. So our intragroup profit is 3 million. What do we do with that? Well, we're saying that inventories are overvalued as far as the group is concerned by 3 million. So I'm going to credit inventories. So let's go up to our statement of financial position and take 3 million away. That's come from working number 7. Which company has made the profit? Acqn sold the goods to Phoenix. Acqn is our subsidiary. So here, inventories from working number 7, I'm going to reduce the group figure by 3 million. In the reserves of Phoenix. So if the parent sells to the subsidiary, it goes through working number 5. When the subsidiary sells the goods, it's always the books of the subsidiary that is the seller. Because you could have a scenario where you've got 2 subsidiaries and one is selling to the other. It's always the books of the seller. So you identify where are the reserves of the seller, and it will either be, if it's the parent doing the selling, it's working number 5. It's the subsidiary doing the selling, it's always working number 2. So we've now dealt with every single piece of information in the question. As always, we go to working number 2. So I've got 95 million, like so. £106 million at the second date. And 111.5 million. So that's an increase of 11 million between the control date and the second acquisition date, and an increase of 5.5 million between the second acquisition date and the SFP date. Once we've done that, we're now in a position to determine goodwill. What we've got to do, we need to deduct the net assets at the control date. Now the control date is this one here. We've established this is when we had a majority stake in AL. So what I'm going to do is I'm going to take away 95 million. So this gives me a goodwill figure of 92.5 million. Next, we've got the NCI. We've got the NCI at the 1st of January X4. We're then going to give them their share between control and acquisition number 3. And during that period, they have 25% of AL. What has AL done during that period? AL has made profits of 11 million. So we're going to give them 2,750. If we're going to give 25% of the profits to the NCI, what are you going to do with the other 75% of the profits? Group reserves. So let's go down to group reserves. Share of AL between control and our third acquisition of shares. That's going to be 75% times 11 million. That's 8,250. So therefore, at the date we make the third acquisition, let's value the NCI. It's 45.25 million. We now need to work out our adjustment. what's happening? On the 1st of January X5, Phoenix bought 15% of Owl. So can you see, as far as the NCI is concerned, the NCI is worth 45,250, and they are giving away 15% of the 25% of the shares that they own. So that works out as 27,150. So I'm debiting the NCI 27,150. That also goes into my adjustment calculation. So here I'm going to debit the NCI. I picked that up from working number 4. 27,150. Looking at this adjustment, it doesn't balance. The only way I can get it to balance is to debit group reserves with the balancing figure of 8,850. So I'm going to go to reserves, NCI adjustment from working number 6, 8,850. So it's all of these things stacking up on top of each other. You've got to deal with them one by one, step by step, and so on. What do we have to deal with now? Well, we've only got as far as X5. So I'm now going to give the NCI their share between acquisition 3 and the SFP date. And during that period, they own 10% of Owl, and Owl has made profits of 5.5 million. Which gives us a figure of 550. If we're going to give the NCI 10% of the profits, we have to give the reserves of the group the other 90%. So share of Owl between acquisition 3 to the SFP date, this is 90% of 5,500, 4,950. Two, 1, 2, 3, 5, 0 is our grand total for reserves. I'm going to take that reserves figure and I'm going to transfer it to the face of my statement of financial position. The NCI adds up to 18,650, and again I'm going to transfer that to the face of my answer. So I've got 18,650 which has come from working number 4. Equity and liabilities adds up to 526,000 on the bottom part of our statement of financial position. We have PPE of 183,000 and we have inventories of 109,500. And if we add that up, that comes to 526,000, which equals the bottom part of our statement of financial position.